yeah, I have something special to share with you guys today. So you guys know I trade the forever model. I've been trading the forever model for the last pretty much year trading futures, and I will pretty much continue to trade it, but there's something that I've added to my system, I've added to my strategy that I want to teach you guys in this video, and I've been waiting to make a video on it because I wanted to use it more and have more confidence in my ability to teach you guys. I don't want to just like say, oh, here it is, here's a concept, here's a concept. I want to actually make money with it. I want to use it. I want to have confidence with it. So in this video, we're going to be covering CRT, candle range theory. And it's something that I've used to add on to my existing strategy to understand the 10 o'clock open of the 4-hour candle, the 1-hour candle, and things that are extremely important with aligning reversals and getting extra confluence, because especially in these types of market conditions, right now it's August, or in summer conditions, sometimes we lack a little bit of clarity on when the market wants to reverse or go towards whatever the opposing liquidity pool is. So in this video, I'm going to show you what is CRT, how do I use it with my strategy, how do I take entries with it, and tying it with the forever model. So without further ado, let's jump into the charts and let's run through it. So the first thing that we want to understand when it comes to CRT is basic of accumulation, manipulation, distribution. So there's the regular power of three where you have accumulation, you have manipulation, and then you have distribution, right? These are the things in which the market does all of the time, where we generate possible internal buy side liquidity. We then have a move above those highs, and then we sell back to the downside, right? So that's what I want you to understand of just like the basics. Now, what actually is candle range theory? So candle range theory is a 3-candle formation. And basically it looks something like this. Imagine we have one bullish candle that's just absolutely flying to the upside. And then the next candle that comes in, when it starts to form, it kind of maybe moves higher, and then we end up coming all the way back down and maybe flipping, and the candle actually ends up closing like this, right? So you have to understand basic candle formation first. If you don't understand basic candle formation, I'll run it quickly through right now, right? A candle is made up of a body and a wick. So the high of this candle is called the close. We have the open, high, low, close. So we have the open of whatever the candle opening price was. We have the low of it, and then the wick that was created on that candle is the high of it. And then the top of the body is the close. You have the low, you have the open, the market goes down, we wick it, that's the low of that time period. And then the market expands higher. The wick is the high of that candle, and then we come back all the way down, and then we close, right? So what you want to understand is that this candle can represent a 5-minute, it can represent a 15-minute interval, it can represent a 1-hour interval. Candles are fractal, right? So anytime we can use it as like a magnifying glass to look into smaller time frames and bigger time frames. And with specifically CRT in this video, I only pretty much use it on the bigger time frame, and I'm going to explain why. So now that we went over that briefly, let's get back into CRT. So this middle candle, what happens is the market moves back higher, and then we end up pulling all the way back, and we close below the recent high of that previous candle. So what is this showing me? Now, most of the time, CRT is basically when this candle ends up going through it, and we close all the way back below. Now, I want to see most of the time, this candle actually flip bearish. The candle can actually start green and then flip bearish. That's the best case of really what I want to see. So now that I have this understanding, what do I expect to do? Well, number one, I expect to go to at least equilibrium of the first candle. So I can use this as a draw on liquidity as well on a bigger time frame. So keep in mind, I'll use this on the 1-hour and the 4-hour pretty much. Sometimes the 15-minute, but the best high probability CRTs is going to be the bigger time frame, 1 hour and the 4-hour, and then you can zoom in and actually use it as a bias to frame other trades off of. Now, the market can also go all the way back to the opposing liquidity of whatever that candle is. So this is sort of kind of what happens is this third candle, what I would expect is possibly to then revert back down to the equilibrium of the previous price leg. Now, what you also want to understand is that this middle wick is going to act like a PD array. What is a PD array? A fair value gap, an order block. It's going to act as something that the market is going to respect. So what I always watch for is this middle candle. I will mark it as a wick, and so I'll mark it as consequent encroachment. Consequent encroachment is the midpoint. So I want to mark the midpoint of that wick, and I want to see price continue to respect it. So let's say this is a 1 hour. The next hour opens. So let's say at 10 o'clock, this is 10 o'clock. So boom, right now, bang, 10 o'clock opens. When 10 o'clock opens, I can expect the market to possibly rebalance into this wick and then end up selling back off to go to equilibrium, and then possibly also the opposing liquidity pool of the bottom of the candle. Now, this is where I want you to think about what's happening on the lower time frame. This is what's happening on the bigger time frame. So now imagine this. What do we actually do with this knowledge? Well, a couple of things, but the first thing that we want to understand is what is price action looking like? So when we see this on a chart, what's actually happening on a lower time frame is a lot of the time something like this, right? Where we'll have possibly an initial move higher and then we'll have that break of structure, right? And we'll start to rebalance back lower. So the market will have that next candle open, we'll possibly rebalance back higher. People think we're going back to new highs when in reality, we just rebalance to consequent encroachment and then we end up selling back to equilibrium of the range and then possibly back to the opposing liquidity pool as well. Now, what do we use with this? I am not most of the time, like 90% of the time, I'm not really taking trades just off of this. I'm taking trades off using this as a confluence with other things. So what is going to give this higher probability? I want to see more reason for the market to reject. Right? Let's say we're in a 4-hour bearish fair value gap and we have a 4-hour CRT candle where we come up, take the recent candle high, fall all the way back down in the range, and then the market, then we're adding some more confluence for us to possibly reject this. Now, another piece of confluence that we can add to this is possibly looking at an SMT, right? Maybe there's an SMT with these internal highs that we have, right? Let's say NQ ends up taking that high. Maybe ES doesn't take that high. Maybe there's a bigger time frame SMT, maybe from the recent high that was, over here. Whatever it is, we want to use CRT to overlap the existing buys. Let's also say that maybe there was buy side liquidity taken to the left of us, right? So let's say that there was some sort of area of buy side liquidity that was taken here to the left of us where then it's overlapping with the CRT as well, right? So we're using it as a confluence tied with the forever model. So what is the forever model? I need to have a confident draw on liquidity. So in this case, I would want to see equal lows. We're in a bigger time frame fair value gap. I'm looking to reject. I want to see the market draw towards sell side, especially if the market opens. I would want to see the market go higher first and then sell off. I want to see an SMT and I want to see a change in the state of delivery. So on the lower time frame, what could potentially be happening here is something like this. Expansion candle, right? Big expansion candle, we end up coming up higher. That first candle ends up closing, right? And then we have this next period of time where we kind of sit here and then we take it and then we end up displacing and then boom, 10 o'clock candle opens. So what's actually happening here? This is basically just this on a bigger time frame or on a smaller time frame, right? So what's happening? We then maybe have an SMT like this. We have a change in the state of delivery and this wick on the bigger time frame is now most likely equilibrium of that price leg. And then we end up coming back to it most likely, whatever bearish fair value gaps here, and that's where I look to take my short entry. So I want to look for the rejection, use the 1 hour or the 4 hour bigger time frame candle to close back inside the range, zoom in, and then look for an entry. What am I looking for an entry? Break of structure to the downside, a change in the state of delivery, and then a possible rebalance, and then look to take a short, targeting whatever the opposing liquidity pool is. And most of the time, I want to take off partials at equilibrium, unless there's super clear sell side liquidity. So for example, right, if this is the candle low and the high, I want to be most likely it depends the probability of the draw on liquidity. It's not a bad idea to take partials at equilibrium of the range unless there's really high probability sell side liquidity resting below. So now that you kind of have a good foundation of what this looks like, let's look at some real examples. And there was actually a perfect example this week on the 4 hour, right? Actually, it was on the daily time frame. So let me show you what that looks like. So we're going to play this out together, right? On Wednesday last week, NQ ended up coming up previously in the week. Monday, Tuesday, we end up taking buy side to the left of us, right? We're overlapping some sort of bias of why would we already maybe want to see us possibly fall back down. We also have a daily fair value gap that we're starting to open, but what am I going to mark out, right? I want to mark out the high of the previous candle that we just closed back below, right? And then I want to mark also the opposing liquidity pool and equilibrium of this candle. So from the low to the high of the candle before the reversal candle. So this middle candle wicks up and we close all the way back down at the end of the day under the previous high of the next candle. So now I also want to mark from the wick, just the wick of that middle candle, I want to mark equilibrium of that wick. So now I zoom in. So what am I using this now for? So this is how I use it to form a bias. So I can use it on the daily time frame, on the 4 hour, and on the 1 hour. And we're going to get into 10 o'clock, which is also super important with how to use this. But now we zoom into the lower time frame and we say, okay, well, what's the market actually doing here? Okay, 4 hour, we actually had another 4 hour CRT. If we look at the 4 hour, we closed all the way back below, boom, went to the opposing liquidity pool. What's happening now? 4 hour change in the state, right? So my bias is bearish. I want to see that candle close below. I want to be leaning more bearish going into the next couple of days. So what ends up happening here is the market ends up starting to sell off initially, but we don't reach back to equilibrium. So this is where everybody starts to get faked out, where the market initially dumps, we don't yet go back to equilibrium. What are we most likely going to do here? We're most likely going to go take internal buy side liquidity where these stacked highs are resting, possibly rebalance to equilibrium of that range and the wick. So look exactly where we end up rejecting. Pretty much to the tick, we end up rejecting that the daily CRT wick, right? So the market comes all the way back up, but this is not invalidating the CRT, right? This isn't invalidating the bias that we have of we want to see the market continue to respect that high, respect this wick and consequent encroachment of it to then roll back over to at least equilibrium of that low, right? So we're expecting the market to sell off here. So what am I looking for an entry? Well, if highs get taken, I can look for internal change in the state as well on the 5 minute to possibly take an entry. Or if it's on a really big time frame like it was this week, I'm most likely waiting for an open to give me the buys for it. So for example, going into Friday, and keep in mind, Friday, I actually ended up missing this trade because I just didn't get the right entry I was looking for. Looking back, I could have taken it. But I want to show you this as an example. Going into Friday, we're continuing to respect this bearish bias. And what ends up adding to the validation of it? If you look at ES here, ES ends up coming up on Thursday and ends up taking the previous day high. So right about here, if you look at the price action where ES is versus NQ, ES ends up taking that high, NQ does not. So now we have a big bearish divergence. A bigger time frame CRT, a bigger time frame SMT that is also bearish. We have not yet gone to equilibrium of the range as well. So everything telling me going into Friday is very, very bearish, and I want to see the market continue to go lower. And this is when I can also, do a little more analysis and say, all right, well, there's a 15-minute bearish fair value gap that we're continuing to respect. I want to see if there's some sort of internal manipulation to go off into Friday morning. So going into Friday morning, we have internal displacement. We end up opening up a bearish inefficiency as well. So once that SMT gets put in, what am I looking for? Displacement. Boom. ES takes the high, NQ dumps. We put in a bearish fair value gap. I want to see this hold, right? Targeting equilibrium of the range and also the internal sell side level that we made from the first move lower. So we have the first move lower, then rebounds all the way back up to tap equilibrium of the wick, then sell back off, then put an SMT in. But again, nothing, this is all chop, right? What you got to understand is because we're in August, this is also why I said at the beginning of the video, this is good to add more conviction, because a lot of this is really not that good of price action and it's not super clear. But what is clear is that the daily time frame is continuously validating that we do want to hold the CRT and end up having a bearish Friday. So what ends up happening? We rebalance to the fair value gap, and what happens going into open? Market opens, we end up having an SMT that gets put in at these internal highs, and we end up looking for the entry. So the entry that I would have been looking to take here that I didn't take because I didn't get the actual entry I want, but when I looked back and journaled, this was the entry that I should have taken, which was SMT got put in, changing the state to the downside, right? We're waiting for a break of structure. So I'm always looking for, on the bigger time frame, if I'm using this bias, I want to look for, again, my forever model, which is buy side liquidity, SMT put in place, a change in the state. So if I'm just using the bigger time frame, again, I'm aligning all of these different things to give me a better understanding and more probability as to what the market's going to do. At the end of the day, successful trading and good trading is nothing more than recognizing how much probability and conviction you can give to a certain idea to be able to also then put on more size potentially as well. We have a lot of things here going into Friday that are telling me we want to sell off. Bigger time frame SMT, bigger time frame CRT, 1 hour fair value gap opened up before pre-market. Market opens, we go higher, right? For the market to go lower, I want to see us go higher first. Market opens, we go higher, takes out these internal highs, puts in a bearish SMT, then we have a break of structure to the downside at the low. We pull back to the fair value gap. This is where I would be looking to take a short, stop at the high, and I would be targeting back to equilibrium and back to that internal low. And you can see how this ends up playing out. We end up pretty much going straight to those lows and equilibrium going into Friday. This is kind of like the first example, and then the second example I want to show you is how I use it when it comes to 10 o'clock, because 10 o'clock, which is 30 minutes after New York open, is when the 4-hour candle opens and the 1-hour candle opens. Soak in this idea. I want you to just take a moment, pause, make sure you understand everything that I just covered with this specific example, and then let's run into the 4-hour and the 1-hour. Okay, I want you to follow along with me here because this is gonna be a little bit possibly confusing at first, but once it clicks, it's gonna fucking change your game. At 10 o'clock, market opens at 9:30. The best opportunity we are going to take is from the first hour and a half to 2 hours of the market. At 10 o'clock is an extremely important point because at 10 o'clock, the 4-hour candle closes and a new one opens, and the 1-hour candle closes and a new one opens. So at 9:30, going into 10 o'clock, I wanna see how the 4-hour candle is going to close. So let's imagine a case where this is what is looking at. There is a bearish candle going into open, but there's a possibility that we might want to reverse. Let's say that there is sell side liquidity resting right below us. Going into open, I would be very, very bearish. I would want the market to continue to go lower because there's still liquidity resting below. Let's just say there's a little bit more, price action here, blah, 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 and then we end up having this candle, right? Whatever. I want you to get the idea of correlating what the bigger time frame candles looks like with the price action. Let's say market opens. Boom. This candle starts bearish. Market opens. We end up dumping. Oh my gosh. So this is 30 minutes, right? From 9:30 to 10 o'clock. What's happening here? This is on the 4-hour, right? So on the 4-hour, this is actually a lot of period of time here. This could be the 4-hour, this could be the 1-hour. But the market ends up dumping at open. This candle expands. And then right before 10 o'clock, this candle closes all the way back inside the range. So again, the market goes lower, puts in a big wick, has taken the sell side, has closed back inside of the candle range, and then 10 o'clock hits, which solidifies the CRT, right? That's locked in. We've closed now below it. So boom, bank right here. This next candle opens at 10 o'clock. What am I looking for at 10 o'clock? I'm looking to take longs. Better conviction for this might look something like this. Let's say there's a bullish SMT here. On the lower time frame, what am I looking for? A change in the state of delivery. What might that look like? Pay attention here. We have equilibrium of this candle. This next candle that opens at 10 o'clock could do this. We could continue to go lower, but I would expect this wick to hold and act as support. So possibly do something like this. And keep in mind, it doesn't have to be 3 candles. So we could do something like this where we actually end up having a false move in respecting consequent encroachment still, and then the next candle ends up having that reversal. I'm hoping this is making sense to you. What is this going to look like on the lower time frame? It's going to look something like this. Let me clear up this so it's easier to understand. At 10 o'clock, I want to see from here, there is possibly a move lower, then a break of structure to the upside, then a pullback, and that's where we would be looking to long. Where would we be longing towards? Possibly the opposing liquidity pool, right? The candle high, whatever the generated buy side liquidity is, and that is where we would be looking to take a long. At the low of the wick, targeting the opposing liquidity pool using CRT. So I want you to understand what I'm saying with this, right? I'm not just using this as an entry model. Now, you can go back test it. You can possibly use it as an entry model. In fact, I do believe you can use it as an entry model, but tie it with other things. Tie it as, hey, there's a CRT candle and we also had taken a high, or we are also in a fair value gap in which I'm already expecting the market to reject. If that's the case, then you can take the trade and I think it'll be great. So hopefully you guys enjoyed this. If you like this kind of video and want me to share more of what I'm doing with my trading, leave a like, subscribe, all that good stuff. Let me know if you want to see more content on CRT. Again, I'm going to be continuously using it with my existing strategy right now. This is something that has completely changed the game for me when it comes to just getting more confidence and conviction in certain market conditions. When the price action isn't super efficient, I can just use candle structure to get an understanding of where I want to see the market reverse, where the market could potentially draw to when it comes to back to equilibrium of the range of the candle or back to the opposing liquidity pool. So without further ado, hopefully you guys enjoyed and I will see you guys in the next video. Peace out.